Hello, good day, everyone. This is Dr. Don Charles. Welcome to my course, Day Trading Stocks. This is my second lecture for my course. Today, we will cover the things you need to know in order to trade stocks. So the content that will be covered in today's lecture includes the types of financial markets, various stock markets, selecting a broker, and demo trading. The first topic for today's lecture is types of financial markets. Financial markets refer broadly to any marketplace where the trading of assets occur. These financial markets facilitate the buying and selling of these assets. There are many kinds of assets. Some of these assets are foreign exchange, also called currency pairs, also called quotations, bonds, commodities, derivatives, and stocks. A foreign exchange is an exchange rate. It is also called forex or currency pair. It is a ratio of one country's currency to another country's currency. The next type of asset is a bond. A bond is a debt instrument. It has two components. The first part is the principal or the par value. That is what you pay to get a bond. The second part is the coupon. That is the interest on the bond. The third type of asset is a commodity. Commodities here refer to primary commodities. These include agricultural commodities like corn and sugar, metals like iron and copper, and energy commodities like oil and gas. The fourth type of asset is a derivative. A derivative is an asset that gets its value from another asset. Some examples of derivatives include futures and forwards contracts. The fifth type of asset is a stock. A stock represents a share of ownership of a company. This course is focused on stocks. Some of the popular types of financial markets are forex market, the bond market, the commodities market, the derivatives market, and the stock market. Can you guess what type of asset each financial market facilitates? The forex market facilitates the trading of foreign exchange. You can buy and sell currency pairs on a forex market. The bond market facilitates the trading of bonds. You can buy bonds on the bond market. The commodities market facilitates the trading of commodities. So you can buy agricultural commodities, you can buy metals, and you can buy energy commodities such as oil and gas on the commodities market. The derivatives market facilitates the trading of derivatives. You can buy forwards contract and you can buy futures contract on the derivatives market. The stock market facilitates the trading of stocks. You can buy stocks of different companies. You can buy shares. Stocks are also called shares. You can buy stocks of different companies on the stock market. Note, there are other types of assets. For example, there are cryptocurrencies. These are digital currencies that are sometimes used as money. However, cryptocurrencies are not legal tender. In other words, they were not issued by any central bank. In this course, I am not focusing on these other types of assets. This course is about day trading of stocks. So I will only focus upon stocks in this course. So the main market that will be of interest to us in this course is the stock market. This will be of interest to us. So there are many stock exchanges. These are some of the common stock exchanges. So we have the New York Stock Exchange. It is located in the United States. The market capitalization, well, the market capitalization here refers to how much money that is being traded on the stock exchange. The market capitalization is 22 trillion. This is a lot of money that is moving on the stock exchange. You have the NASDAQ. This is also located on the United States. The amount of money traded on the NASDAQ stock exchange is 10 trillion. We have the Japan Exchange Group. This is located in Japan. The market capitalization is 5 trillion. We have the London Stock Exchange, located in the United Kingdom. The market capitalization is 4.5 trillion. We have the Shanghai Stock Exchange. It's located in China. The market capitalization is 4 trillion. We have the Hong Kong Stock Exchange. It is located in Hong Kong. The market capitalization is 3.9 trillion. We have the Euronet. This is located in the European Union. The market capitalization is 3.9 trillion. We have the Toronto Stock Exchange. It is located in Canada. The market capitalization is 3.2 trillion. We also have the Bombay Stock Exchange. It is located in India. The market capitalization is 2 trillion. So this is the volumes associated with each stock exchange. You can see a lot of stocks being traded on the stock exchange. So roughly 1.4 trillion is traded on the New York Stock Exchange, as opposed to on the Bombay Stock Exchange on India, we have 210 billion stocks being traded on the stock exchange monthly. These are the times associated with each stock exchange. So the New York Stock Exchange, the time associated with this stock exchange is the Eastern Standard Time. Well, this is this time zone that is applicable to New York. The stock exchange opens at 9:30 a.m. and closes at 4 p.m. So you see that it's very common. Stock exchanges open at 9:30 a.m. It closes at 4. The Japan Stock Exchange opens at 9 a.m. Japan Standard Time. It closes at 5 p.m. The London Stock Exchange opens at 8 a.m. Greenwich Mean Time. It closes at 4:30 p.m. This is just the general times that different stock exchanges open. There are many different brokers that facilitate the trading of stocks. If you want to trade stocks that are trading on this international exchange, you have to use one of these brokers. Observe, I use a technical term, exchanges. A financial market is sometimes referred to as an exchange. In Trinidad and Tobago, my country, we have a stock exchange to facilitate the trading of stocks. This stock exchange is called the Trinidad and Tobago Stock Exchange, the TTSE. You can buy and sell stocks on the TTSE. Should you buy stocks on the TTSE? Well, you can if you want to invest. Recall in a previous lecture, I said investing refers to buying and holding stocks. Well, you can invest in stocks on the TTSE. Can you trade stocks on the TTSE? Well, I can say that a TTSE is not the ideal location to buy and sell stocks. This is due to stocks on a TTSE exhibiting very low volatility. Recall, traders make a profit by buying and selling volatile stocks. These stock prices must move in order for the traders to make a profit on their price. If the stock prices do not move, the trader will not profit from changes in the price of these stocks. On the Trinidad and Tobago Stock Exchange, the stocks do not exhibit strong volatility. The prices do not fluctuate by much on a daily, monthly, or even on an annual basis. In fact, there are many days, many weeks may pass, and some stocks can exhibit no change in their prices. This is due to weak market activity. In other words, some days or weeks may pass and no one may buy or sell certain stocks. Apart from the lack of price volatility, the lack of volume is also a problem for a trader. In fact, if a trader wants to buy and sell a stock quickly, they will be unable to do so. Why? Because there may be no one selling the stocks. This is a big problem because traders profit from getting in and out of stocks very quickly. If you can't do this, then the TTSE is not the ideal place for them to trade stocks. In the past, the TTSE had no online platform. An online platform is a software that facilitates the trading of stocks online. Therefore, you could not buy and sell stocks from Trinidad and Tobago online. You had to go physically to a broker and place an order to buy or sell a company's stock. These factors, the weak volatility, the low trading volume, and the absence of the online platform caused the TTSE to be inefficient. For those of you with a background in economics might be familiar with the term efficient market hypothesis and the testing for efficiency in different financial markets and stock markets. For the purposes of this course, you do not need to go into the mathematical proof of efficient market hypothesis. I will teach you what you need to know in order to trade the financial market. For now, just note that the TTSE is inefficient for the aforementioned reasons. These reasons are the weak volatility. Volatility here refers to the fluctuation in price. So there's weak volatility, there's weak fluctuation in the price of assets on the TTSE. There's low trading volume, meaning that for any stock, a very small volume or a very small percentage of its total shares can be traded on a daily basis. And historically, there was an absence of an online platform, meaning that you could not buy and sell stocks online. Presently, there is an online platform. I think this was introduced in the year 2020. However, not much people are aware of this online platform, and many people still do not trade stocks on the TTSE. So the TTSE is inefficient. It is not the best place for a trader to make money. If you want to invest, you can invest in stocks on the TTSE and wait for dividends. If you want to trade, trading is a practice where a retail trader buys and sells assets with the objective of making a profit from changing the price of an asset. If you want to trade stocks, you need to consider international stock markets. In order to access the international stock markets, you need to use one of the brokers. The notable brokers are Ameritrade, Robinhood, TradeStation, Webull, Interactive Brokers, and Capital Markets Elite Group. These are just some of the brokers. There are more brokers than these 6 mentioned here. There are many, many brokers. These are just some of the brokers that are available to trade stocks on these international financial markets. So you may be asking, or you may be wondering, which broker should I choose to trade stocks on international financial markets? You want to know which one you should choose? This one, Capital Markets Elite Group. Now, I'm not saying this because I'm endorsing or promoting any broker. I am just giving you the facts. I am just giving you information you need to know in order to trade the financial market. So you may be wondering, why single out this broker? Why should anyone choose this broker, Capital Market Elite Group, to trade financial markets? This is due to the position day trading rule. In the United States, the Securities and Exchange Commission, the SEC, and the Financial Industry Regulatory Authority, FINRA, have a rule called the Position Day Trading Rule, PDTR. This requires position day traders to have a minimum account balance of US $25,000 in order to trade stocks on margin. Recall, in the previous lecture, I mentioned margin is also called credit. Many traders trade stocks on margin, meaning that many traders trade stocks on credit. Margin means to trade on credit. When you trade on the financial market, the broker gives you margin, leverage, or credit to trade. The SEC classifies a day trader as anyone that makes 4 round trips in at least 1 week in their stock trading account. A round trip is where the trader opens a trade and closes a trade. So if the trader buys a stock, they open an order. When they sell the stock, they close the order. The process of opening and closing a trade is called a round trip. Once you complete at least 4 round trips at least once in your stock trading account, you will be classified as a position day trader. Therefore, you will need to have a minimum account balance of 25,000 US if you want to trade stocks. So you may be wondering, how can you get around this position day trading rule? Well, you can choose to trade with Capital Markets Elite Group. This broker is registered here in Trinidad and Tobago. They are not fully covered by the SEC and the FINRA rules. Therefore, they do not adhere to the position day trading rule. Capital Markets Elite Group has a minimum account balance of 500. So if you have $500, you can trade stocks with this broker. I want to emphasize again, I am not advertising or promoting this broker. I am just informing you what you need to know to trade stocks. Can citizens of the US open an account with Capital Markets Elite Group? Yes. However, they have to go on Capital Markets website when they're registering, and they have to say they were not solicited by the broker. This is just a technicality. Demo trading. Now, it's common knowledge that many traders fail in trading. In other words, they take unnecessary losses. So you may be asking, why do these traders end up failing? That is because they never demo traded. They get excited about the whole idea of trading, and they started to trade assets without ever practicing. This is the case for stocks, forex, commodities, etc. It doesn't matter which asset. If they trade the market without practicing, if they trade the market without ever engaging in demo trading, there's a very strong possibility that they could end up losing a lot of their trades. They could end up losing a lot of their money overall. Demo trading is where the trader trades with fake money. They do not trade with a live account. A demo account is where the trader opens a fake account, then they practice trading with fake money. Traders should practice demo trading as they can get a feel of the market. They can practice looking at charts, opening orders, closing orders, and setting limit orders. Recall, in my course, A Practical Introduction to Day Trading, I went into detail about the different types of orders, and I explained what are market orders and what are limit orders. You can review my course to refresh your memory what are market orders and what are limit orders. When traders engage in demo trading, they can implement various strategies. They can read the news and try to trade stocks based on the news. And they can practice implementing various strategies and managing their risks. Demo trading is a place where a trader practices trading. Trading is a skill. Like any other skill, a trader needs to refine their trading skills. This can be done through practice. A trader also needs to learn to control their emotions while trading. Emotions, you may be wondering where the whole concept of emotions come in. Well, people have emotions. Everyone wants to win. No one wants to lose. However, if they enter a trade and it turns into a win, what will they do? Will they get greedy and risk more? If they risk more money in a trade and the trade turns to a win, they can make more money. However, if the trade turns into a loss, they can lose more money. Likewise, if a trader enters a trade and the trade starts off in a loss, what will they do? Will they hold the losses too long? Will they close their loss? Or will they try to take revenge on the market and try to make back all the money that they lost by risking more? Traders need to be composed while trading. They need to implement a strategy. They need to trade with a strategy that is statistically proven to generate more wins than losses. If they do not implement a strategy, they will not properly reap the benefits of the strategy. In other words, they need to stick to a strategy. They should focus on implementing a strategy and do not continue breaking a given strategy. The reason why I want to emphasize do not continue breaking a strategy will have strict rules for them to enter trades and for them to close trades. In other words, there will be certain market conditions, and only when these market conditions occur, you can place an order to buy, and when certain market conditions occur, you can place an order to sell. You will have a target profit, you will have a stop loss. So you have to stick to these rules in order to implement a strategy. Now, sometimes a trader might have to wait a very long time for these market conditions to be met. In other words, sometimes in some days, these market conditions will not be met and they will not get any signal for them to implement a trade. Some traders are very anxious. They do not want to wait many days for certain market conditions to be met in order for them to implement trades. So they break their strategy. If traders keep practicing breaking their strategy, they may not reap the full benefits of their strategy. They need to stick to their strategy. If a strategy is objective, it has well-defined rules for entry and exit. It has well-defined rules to buy a stock. It has well-defined rules to sell a stock. They need to stick to their strategy. If they do not stick to their strategy, they may not reap the benefits of their strategy. In another scenario, some traders may frequently be changing their strategy. In other words, they may start off with one strategy and then they may be informed by perhaps a friend that they are using another strategy. So they want to use the strategy of their friend because their friend told them that the strategy that they are using is very profitable. So the trader changes their strategy. Then another friend tells them that they're using a different strategy. This causes the trader to change their strategy again. Then another friend tells the trader that they're using a different strategy, and the trader changes the strategy again. If a trader continuously changes their strategy, they will not fully reap the benefits of their strategy. They need to stick to their strategy. If you're trading based on a strategy, you're trading based on well-defined rules. When certain conditions are met, you enter an order, you enter a trade to buy or to sell an asset. You have to stick to your strategy. If you keep changing your strategy, you will not reap the benefits of your strategy. So you may be asking, how long should a trader demo trade? This should be done as long as possible as it takes to build proficiency. The key word is proficiency. You need to trade as long as it takes for you to develop and acquire the skill. Trading is a skill. You have to develop the skill. In fact, a trader should practice trading with a demo account and they should be able to double their demo account. If a trader cannot grow a $500 demo account into a $1,000 account, then they will not be able to grow a live account. That is very realistic because if you cannot grow an account with fake money from $500 to $1,000 or to $2,000, if you cannot double, triple, or increase an account by 4 times, a fake account, if you cannot grow a fake account, then more likely than not, you will not be able to do it with a live account. That is just the reality. A trader needs to practice trading a demo account, practice implementing strategies, practice managing their risks, practice managing their emotions, and grow their account. Only when a trader has proved to themselves that they can grow a demo account, then they should start trading live. Note, you can't cheat yourself. If you don't practice and you go on the market with your real money and you have not fully mastered the trading skill, well, your account will fail in the end. So my advice to any trader is to start with demo trading. And only when you have developed proficiency from demo trading, then you can go on a market with a live account. So this brings me to the end of this lecture. Thank you for listening and stay tuned for more. Thank you.